The first quarter of 2024 was off to the races for the stock market. Bond markets flat, Federal Reserve hinting at lowering interest rates, and the possibility of a looming recession. All of this and more right here for the Modern Wealth Educational Series. Stick around. Thanks so much for joining us here on the Modern Wealth Management Educational Update. I'm Dean Barber, Managing Director of Modern Wealth in Lenexa, joined by Bud Kasper, Managing Director of Modern Wealth in Lee Summit. Also joined by Stephen Tuckwood, Chartered Financial Analyst and Director of Investments out of Atlanta, Georgia. Tuck, welcome.
Thank you. Glad to be here.
And Bud, welcome.
Yeah, we've got a lot to discuss today. I'm anxious about this. And Tuck, thank you for being on.
Yeah, so we're going to really tackle in this educational series economic events, data from the first quarter. We're going to discuss interest rates. We're going to discuss predictions for the Fed's actions so far, corporate debt, personal debt. So, Tuck, give us a really quick recap of, as a chartered financial analyst, what do you see from the first quarter of this year? It seems like nothing could go wrong from an equity perspective. Broad markets are all higher. The breadth of the rallies in the markets is much broader than what it was in 2023. And the only real place that we haven't seen a lot of excitement is in the bond market. And we'll get to that here in a few minutes. But let's discuss what's happening in the equity markets and why everything is seeming to go higher.
Yes, it's a good point, Dean. And it certainly has been a nice quarter for risky assets and the equity market in general. And as you say, a broadening out. Our concerns last year were that it was a very narrow market and that just a few mega cap tech names were driving things forward. But now we're seeing that, those names are still doing well generally. But like you say, there's been a broadening out there across the board, which is a healthy sign typically for the equity market to move in that way. So pleasing there. Corporate earnings have remained solid. We should have some decent growth there in that metric, and general levels of liquidity in the system is helping out as well. So combine those two things together, and that typically leads to a nice performance in the equity markets.
GDP last year came in approximately 3.1%. I believe that's the correct number on that. We started off the quarter really quite vibrantly, and it's amazing to me that we can continue on this pace, and it questions whether or not we can sustain this type of growth for a longer period of time. One of the issues that bothers me a lot, and I'm going to make a quotation here because there's a lady by the name of Maya McGinnis, and she's president of the Committee for Responsible Federal Budget, stated that we are in a terrible trajectory in terms of fiscal finances in the United States, with $34,602 billion and some change in total national debt. Is that going to eventually have an impact on what our economy is going to be able to do, Tuck?
I think it has to at some point. Yes, just servicing that amount of debt just becomes such a burden for the federal government that they're not able to help the economy in other ways when it's needed. And I think I heard the other day that the expected interest expense is going to be higher than defense spending this year, or some time period. Don't quote me exactly on that, but the general idea is that it's just such a huge amount of money to come up with just to service the existing debt. That's not to say not including, as we're running deficits continuously, that number grows as well. So at some point it really does matter, and we won't know until we see that.
And will that be reflected then in the stock market being able to continue its path of growth?
I think, if it spills over into the broader economy and, we have issues in the bond market, that typically leads to a reduction in risk appetite across the board and could lead to a decline in the stock market as well, for sure.
So as we think about debt, Tuck, it's not just about the federal debt. They're not the only irresponsible ones in this country. And we see credit card debts at all-time highs. We see automobile debts skyrocketing, and we're starting to see cracks in that foundation, and we'll get to corporate debt here in a minute. But I want to go to personal debt first, and that personal debt being credit cards and automobile debt, and we're starting to see a lot of defaults in those two areas. So what's your take there?
Yeah, that's one of the weaker kind of canaries in the coal mine that we're looking for with the economy. So as we stated in the beginning, things generally look really healthy. Strong job market, inflation's remaining stubbornly high, but not increasing in the rates that it was. GDP strong and such. So, where are we looking for signs of potential weakness? Well, what we see is just a little uptick in the amount of delinquencies in credit card receivables and on auto loans. So that's really, at the kind of front edge of the economy for folks that are borrowing perhaps beyond their means, and with rates moving materially higher over the last couple of years, we're starting to see just the impacts of that potentially there. So definitely something to watch out for as a sign for maybe a little less vibrancy in the economy in general.
Yeah. So now let's go to the housing market really quick, because that's another form of personal debt. And when we think about the housing market, we had notifications here just recently that you look at applications for home purchases for mortgages is off about 16% from what it was a year ago. Obviously, refinances are down. We've got that 30-year mortgage hovering right around 7%. So as the housing market slows down a bit, Tuck, is that something that the Federal Reserve's looking at, and the excess debt and the start to have the delinquencies? Is that why we had Jerome Powell at the latest meeting hint to seeing 3 rate cuts in the future?
Yeah, potentially. It's honestly a bit of a puzzle as to what they are seeing that has led to them, pivoting in their stance here and suggesting that rate cuts are on the horizon. But yeah, potentially that's an area that they're seeing, as they're reviewing all their packets of data. And the housing market in general has been a really interesting area to look at, because home prices have remained very high. And a lot of that is to do with the lack of deals just getting done, in that if you're in your home and you refinanced during very low rates, you're looking out there and saying, well, if I move today, I have to reestablish a mortgage at significantly high rates. And when people are buying homes, they typically think in terms of monthly payments rather than, actual top dollar value of what the house price is. So, there's a lot of folks just staying put, and that means that, the market in general is not operating the way that it typically does, and not seeing as many deals and that kind of price discovery.
That could be kind of a double-edged sword, though, because if people are staying in their homes longer, maybe it is a sign that they will, do more home improvements in their existing homes. But then you kind of reflect back on what happened during COVID, and so many people spent so much money on home improvements and projects in the yards and those types of things because they weren't able to travel. And so the question really becomes is because people aren't moving now, did they spend the money earlier? And is that going to start to hurt industries like the home improvement areas, appliances, those types of things, because there's not as much activity? And I think when you start to talk about these issues and you start to talk about the tightrope that the Federal Reserve is walking, trying to tame inflation, getting it back down to their target level without causing a recession is a very difficult task. And we just, by the way, for people that weren't paying attention, broke the record for the longest period of time with a yield curve being inverted. In other words, the long end of the Treasury market has lower yields than the short end of the market, and never in history have we seen an inverted yield curve last this long, and leaves many people asking the question, don't inverted yield curves lead to a recession? And well, historically, yes, but at what point in time do they lead to a recession? And is the Federal Reserve under Jerome Powell got some sort of magic wand that they're going to be able to wave and prevent a recession? And it's kind of, if they do it too quickly and start lowering rates, that threat of inflation coming back is very real. That hurts everybody. But if they don't do it soon enough, these parts of the economy that we're seeing start to crack today could really turn into something negative. So it's a kind of a conundrum that the Fed finds itself in today, and we're still trying to unwind ourselves from COVID.
Yeah, I totally agree with that. I think the issues that they face, and everybody's thinking that they're going to make a move, by June. I don't think they will, because they don't want to have egg on their face. They don't want to go in and start raising rates only to have to drop them again.
Lowering rates.
Yeah, lowering rates. Yeah. So I don't think that there's going to be a move until we get to possibly the very end of the third quarter. We'll see what happens, won't we?
Yeah, we will. What's your take on that, Tuck?
Yeah, I'm in the higher for longer camp, and I see the risk of inflation ticking up again if they move too soon. So as long as the job market remains healthy and just in general, a decent economy, I just don't see the need to cut rates at this point. And I was really surprised by the talk last year that kind of led to a rally across the board in risky assets, based on that. And
that rally's still going, and it continues to broaden out.
It is, yeah. And so we have 6 more Fed meetings on the calendar for this year. Next one in May, and we don't expect to change there. So as Bud mentioned, all eyes are on June right now. But to say there's going to be 3 throughout the year, unless something really, exogenous shock or something to that extent, I just don't see how that plays out.
So Tuck, we've tackled, and Bud, we've tackled the national debt, we've tackled the individual consumer debt. Let's talk about debt on corporations. And, most corporations carry a fairly significant amount of debt, some far more than others. But that debt is rolling over, on a consistent basis here, because that's how the corporate debt works. And people or corporations that had debt at 2% or 3% or 4%, as that is renewing and rolling over, they're seeing that debt at 6, 7, 8, 9%. And at some point in time, that's going to start to put cracks in the companies who have too much debt on their balance sheet, that are going to be forced to do something, lay workers off, raise prices. How are they going to stay competitive, and how are they going to stay profitable when their debt starts rolling over and they have so much higher debt service?
Yeah, and I think a great example of that is actually in the small cap companies. So there's a big bifurcation in the performance over this past year of large cap companies versus small cap. So, Russell 1000 versus Russell 2000. And I think part of that is because a lot of the Russell 2000 constituents are generally unprofitable companies, and their debt service load is proportionally a lot higher than larger companies, which tend to have more business lines and whatnot, and able to diversify a bit better. So I think that's the concerns there that will be reflected in the small cap space. So, our view there is generally to tilt towards quality names if you are employing small cap exposure. As you say, these refinancing rates are significantly higher. So when it comes time to roll that debt, it's it's a bigger nut to crack in terms of servicing the debt going forward.
Goldman Sachs over the weekend said stocks have limited upside from here. That was a quotation from one of the gentlemen that was referring to with that. What's your thought on that?
Well, it's already been a really significant rally in Q1. So, I think a lot of the outlook for the next 6 months is really starting to get baked into the price of the S&P.
The one place that we haven't seen it get baked into the price yet, Tuck, and I want to spend just a couple of minutes here before we wrap up our educational series, we haven't seen it get baked into the price of bonds yet. And, you look at the 10-year Treasury, we were at about 5% early November last year, dropped down under 4% before the end of the year. Now it's hovering around the 4.2 to 4.35 mark. And so even though you've got a Fed hinting towards lower rates in the future, you really haven't seen the movement in the Treasury yields. You still have got the 3-month and around 5.2 to 5.3, depending upon the day you look at it. And the 10-year's hovering that 4.2 to 4.3. So not a lot of movement there. So does that tell us that there is a potential tailwind for fixed income investments for the foreseeable future if, in fact, we do get the rate cuts from the Fed? That so if I guess here's the question: we've seen the rally in equities, limited upside according to Goldman Sachs, but we have not seen that same rally in fixed income. So does that tell us that we need to start paying attention to the fixed income sector and look to that as someplace that we could get some decent returns for the balance of the year?
Yeah, I think just with starting yields being so much higher, that's often a big driver of future returns for any fixed income. That's makes it more of an attractive place to look for sure. In terms of spreads in corporate bonds and high yield bonds, which is the incremental yield you get for taking credit risk in corporations versus treasuries, that's actually really small. It's really tight, in other words. So, corporate bonds and high yield bonds are priced to perfection in terms of, the outlook for those companies. So, we're less excited about those spread sectors. But in general, yields are, a good place to be. And the bond market is kind of behaving well this year. And like you say, 4.2% on a 10-year treasury, it seems like a decent yield. Not as high as it was, at 5. But yeah, generally an okay spot to be, and is there for your insurance of your portfolio too. So, if we do hit a bump in the road and equity markets reprice lower, we should expect that 10-year yield to come in as well, and we'll benefit there from having some exposure.
So what you're saying is, I'll put it in layman's terms, the bond portion of a portfolio could begin to act as a ballast again for the portfolio, as opposed to an anchor like it did in 2022, and even a lot of 2023.
Right. Yeah, it was obviously a difficult time for a traditional balanced portfolio, given that fixed income wasn't behaving well. But I think now, kind of duration is our friend again from a portfolio construction standpoint.
I'd like to end, as I know we're getting near the end of the session here, but I want to talk about last year's return of the Magnificent Seven and its impact on the S&P 500, and asking the question, is there a chance that there would be a repeat of that? And would you mind describing that for the purposes of our viewers?
Yeah, so, the Magnificent Seven, as you mentioned, just large cap tech names that did really, really well in 2023. And, I just reminded of that old adage that, trees don't grow to the sky, and that, good things can't possibly continue in the way that they were. Not to say that they're, going to have a collapse at any moment, but, those types of returns, that type of growth in any company just can't continue. There are some fundamental changes that, argue against that, such as artificial intelligence and the like for some of the names involved. But generally now we're seeing a broadening of the equity market, which is, again, more of a healthy sign than what we had in 23, which was just really not healthy to see the overall market being dragged higher by just a handful of names. That's never really a good thing.
Well, gentlemen, Bud, Tuck, thank you both for joining us here for the Modern Wealth Management Educational Series. Wish both of you the best, and until next time, we'll probably do this again by the end of Q2 and kind of see where our predictions came in, and see if we got a recession by then. Maybe Bud was wrong on the June rate cut. Maybe we'll have something there. We'll know more as the year progresses. But anyway, thank you both for being here.
Pleasure.
Thanks.
Thanks again for joining me here on the Modern Wealth Educational Series. If you enjoyed this, make sure you're subscribed to the Modern Wealth channel, as well as sharing this with your friends.